Okay, so this will be our last part of market efficiency lecture, and there is one more anomaly that I want to talk about here. This is something that is not covered in your textbook, like the 52-week high effect. So you might want to take some notes here. This one is referred to as the asset growth effect, right? And this is based on let me write this down, based on growth in total assets, right? So this growth in total assets are in the balance sheet, right? To balance sheet left hand side, total assets equal liabilities plus equity. The evidence in the historical data suggests that firms that have high growth in total assets, right? High growth in total assets, they actually have poor performance. All right, so let me again write that down, and then we'll talk about this. So high asset growth firms have poor performance. All right, high asset growth firms have poor performance. So what do we mean by this? So again, if you, let's say, have a firm that has $100 million in total assets in 1 year, and then the following year the total assets grow to 120 million, right? So that's 20% annual growth in total assets, right? 20% annual growth in total assets, and that is the asset growth effect that I'm referring to here. So when firms have high growth rate in their assets, their subsequent performance has been poor in the historical data. When firms have low growth rate in assets, their subsequent performance is relatively better. So in this instance, you want to buy the firms with low growth rate of assets, and you want to short the firms with high growth rates of assets, right? And the difference here historically is quite large. The low growth minus high growth portfolio, right? Long low growth and short high growth, that return difference is about 20% per year, right? So that's a significant return for a long short portfolio, right? Why does this asset growth effect work? Well, a popular explanation is that maybe investors are overly optimistic about the prospects of these high growth firms, and they bid up their price too high and subsequently realize their mistake and the price actually goes down. Okay, so it's an overreaction type of a story, that investors are overreacting to the future prospects of these high asset growth firms, and when those prospects don't materialize, these firms experience lower returns. All right, so this is the asset growth effect. So there are numerous return patterns like this. I mean, we can keep on going talking about many different return patterns, but I just wanted to give you a flavor of some of the most popular ones, most extensively studied ones, and hopefully that gives you a good foundation to explore this area further. All right, now how do we interpret all this evidence, right? This seems to be inconsistent with market efficiency, but there is a, a group of people, proponents of market efficiency, who believe that this evidence does not necessarily constitute evidence against market efficiency, right? All these return patterns do not necessarily mean that markets are inefficient. Why? Because the argument is that perhaps there is some missing risk factor or factors that are driving this superior performance of some of these return patterns, right? So for example, somehow low growth firms are riskier than high growth firms, and therefore they have higher returns, or winners in momentum are riskier than losers in momentum, and therefore they perform better, and so on. So it's like a risk return trade off type of story. We do not know all the risk factors, So that is the argument that perhaps those missing risk factors are responsible for this observed pattern. So that's the Farmer and French sort of group. But the other group, which has sort of gained a lot of ground in recent years, is the it's predominantly the behavioral group. Actually, they believe that markets are not efficient. There are mispricings in the market, and the source of this mispricing is investors' behavioral biases. People do not always act in a rational manner, and that irrational behavior leads to mispricing. So our entire next lecture is actually devoted to behavioral finance. So I'll talk about some of these things at that point, right? So it could be a risk-based explanation, or it could be inefficiencies arising from investors' behavioral biases, right? Um, there's also this concern of data mining, and data mining in this context basically means that when thousands and thousands of people look at the same data again and again, analyze the same data repeatedly, some of them are bound to find some return patterns, right? I mean, everybody's using the same US data. It starts in 1926 up until now, and everybody is looking for these type of return patterns, looking for some profitable ideas. So purely by chance, some of them are going to find some return pattern, right? So this is a fluke. It's like a statistical fluke. It's not really there. It's just in the sample that we are looking at, and it's not repeatable. It might not arise again in future, right? So some of these return patterns, for example, the small firm effect, or I mentioned the weekend effect in class, some of these have diminished or disappeared over time, right? So they were there in the data at one point in time, but they are not there in the future data, right? So subsequent data. So that is what data mining is, that these return patterns that we are talking about, they're not really there. They are just chance occurrence, right? However, there is a way to get around this data mining issue, and that is to look at these same return patterns in other data sets. Like for example, if we have if you look at momentum, right, it's there in US data, but it's not just restricted to US markets. It's there in pretty much all countries around the world. So it's there is sort of more robust evidence that something really is going on here, and it's not a statistical fluke. All right, so there are ways to get around this data mining issue. Okay, and then one last part here is looking at the performance of mutual fund managers and financial analysts. Okay, so the idea here is that these are experts, right? Fund managers, financial analysts, they are experts. They have the expertise to analyze securities, make investment decisions. They are trained to do this. And if so, the question is, can these experts, these so-called sophisticated market participants, can they actually deliver superior performance, right? If there are inefficiencies in the market, if there are securities that are mispriced, who is best positioned to take advantage of those mispricings? It would be these experts. So that's why we look at their performance in this context of market efficiency. How well have stock market analysts recommendations done, right? How can we rely on their analyst recommendations? So talking about recommendations here, let me actually show you something here on Yahoo Finance. um, Again, we can look at an example, going back to our Microsoft example again. So financial analysts, they basically analyze the companies, look at a lot of different things, and then come up with their forecasts and their recommendations, right? And what we are talking about here are analyst recommendations, right? So on this Microsoft quote page on Yahoo Finance, here you can see the recommendations, right? So analyst recommendations, they are quantified on a 5-point scale. So you can see that 5-point scale here, 1 is a strong buy, 5 is sell, 3 is hold, and then you have all this intermediate ratings in between, right? So 1 is strong buy, 5 is sell, 5 is the worst rating, 1 is the best. And so you can see for Microsoft there are 35 analysts covering the company, right, as of December. And on average, the recommendation is 1.6 right now, right? 1.6, and 1.6 is basically what? So 1 is a strong buy, 2 is buy, 1.6 is kind of in between. So it's basically a buy recommendation, right? So on average, analysts are saying that Microsoft stock is a buy, right? So the question is how well these recommendations perform. Can I follow the analysts? If the analysts are saying buy or a strong buy, right, and I buy those stocks, and when they are selling or when they're saying sell or underperform, like 4 or 5 rating, I sell the stock, right? So I'm just following the analysts. I'm assuming that they are experts, they know what they're doing, and therefore their recommendations would be beneficial in coming up with the trading strategy, right? If analysts are really making the right recommendations, what we should expect is that this type of strategy of buying the strong buys, for example, and selling the sells, it should do well. uh, Before I talk about what that performance looks like, there's one important thing to mention here is that if you were to take all the recommendations of all the analysts and put them together, right? So for some stocks they have 1, for others they have 2, and so on. I put together all the analyst recommendations for all the stocks and I take the average. Now you would expect that the average would be right in the middle, right? So you should get an average close to 3, but it turns out that the average analyst recommendation is actually a 2, right? It's a 2, it's not a 3. So buy is an average recommendation, all right? And so that is important to keep in mind in looking at the evidence here, because it seems like analysts on average are optimistic. They tend to give more buy recommendations as versus sell recommendations. So buy is nothing special. Buy is just average. But then you can say, well, okay, if buy is average, I'll focus on strong buys, and I'll focus on sell, and I'll buy only those stocks for which the recommendation is strong buy, and so on, right? Well, it turns out that strategy does not do very well. If you just rely on the recommendations, that strategy is not going to perform very well. You cannot earn superior returns simply following analyst recommendations, right? So that is one part there. The other part is upgrades and downgrades, right? So you can see that right here for Microsoft. Um, some analysts upgraded the stock in January. A couple of analysts actually upgraded or maintained the recommendation, right? But upgrades would mean going from uh, say hold to buy, right? So that would be an upgrade, or buy to strong buy, that would be an upgrade, right? So you're basically upgrading the stock, you're changing your recommendation on the stock. And downgrade of course would go in the other direction. So then the next thing that we can look at is how well do upgrades and downgrades perform, right? So the level of recommendations themselves are not very useful, but what about changes in recommendations? So here the strategy that we can think of is that I'm going to buy the stocks that are upgraded, and I'm going to sell the stocks that are downgraded, or short sell the stocks that are downgraded. That strategy historically would have produced a superior performance. As you can see here, some numbers: positive changes are associated with 5% gain, negative changes are associated with 11% decline, right? So upgrades you get 5% return, downgrades you get a negative 11% return. So that seems to work. But the question is, why is this working? Is it because analysts are skilled in figuring out when to upgrade and downgrade, or is it the case that markets are just responding to what analysts are doing, right? So when analysts say upgrade, everybody starts buying the stock and the stock price actually goes up because of that buying. Or when the analysts say downgrade, right? So when they downgrade the stock, everybody starts selling the stock, and therefore that selling pressure actually leads to decline in the stock price. So it's not that the analysts are skilled, maybe it's just that the markets are reacting to analyst recommendation changes, and that is causing the upward or downward movement in prices, right? So there is some evidence here, but the explanation regarding that is not convincing. If analysts are skilled in identifying inefficiencies, then of course markets are inefficient. But if it's just the market reaction to their recommendation changes, then we cannot say that markets are inefficient. So and of course the levels are not very useful. So overall the performance, as far as the performance of analysts is concerned, in terms of their recommendations at least, it does not contradict market efficiency. Okay. What about mutual funds? So mutual fund managers, and here we are talking about actively managed funds, right? Funds which are actually trying to beat the market, trying to beat their benchmarks. Are these funds able to do that? And again, the evidence here is that a majority of actively managed mutual funds, and we are talking about 75 to 80% of these funds in any given year, they're not able to beat their benchmarks, to beat their passive benchmarks. So this is suggesting that even these fund managers who are basically experts and who are in the markets every day trying to pick securities, trying to time the market and using other active strategies, they are actually not very successful for most part. So, people have looked at the performance of mutual funds in a number of different ways, adjusting for risk in variety of ways. For example, here is one way to do this, to adjust for performance for risk using Fama-French factor, also including momentum factor and things like that, right? So there are a number of different ways in which you adjust for performance using CAPM or using other asset pricing models and so on. And here is basically the alpha of mutual funds historically. I mean, this is for 1993 to 2007 period. This is the alpha for actively managed mutual funds using the Fama-French three-factor model with also controlling for momentum. All right, and what do we see here? Well, if you were to just sort of look at the average alpha, it's basically zero, right? You can see the average is kind of around zero. This is a frequency distribution of alpha, right? So the majority of funds actually have zero alpha. There are many that actually have negative alpha. There are some that have positive alpha, right? And they're relatively few. Now the ones that do have positive alpha, right? Why are they doing well? Are they doing well because they are skilled, or is it just luck, right? So that goes back to that same issue of luck versus skill that we have talked about before. So in order to look at this luck versus skill issue, what people have done is people have looked at performance persistence. So performance persistence is basically that if a fund does well in 1 year, that might be due to chance. But if the fund is able to consistently deliver superior performance, perhaps there is some skill involved, right? So if good performance persists, perhaps there is some skill. So maybe there are relatively few funds that do well, but maybe they are doing well because they are skilled, and therefore they will keep doing well in subsequent years too, right? And that is what people have looked at. And overall, the evidence regarding persistence is weak. I mean, it's not very strong. It basically suggests that 1 year good performance does not necessarily guarantee future good performance. Okay, so there's not very strong and convincing evidence regarding performance persistence. So overall, the performance of actively managed funds has been quite disappointing. We would expect that these would be the funds who would be able to take advantage of any inefficiencies in the market. So if they are not able to actually take advantage of these inefficiencies, then perhaps markets are actually quite efficient, right? So that is the same conclusion we draw whether we look at the performance of mutual funds or financial analysts. Okay, so so here is sort of the overall picture, right? So we've looked at a lot of return patterns that seem to suggest that perhaps markets are not efficient, and yet the people who are best positioned to take advantage of these inefficiencies, the fund managers, the financial analysts, they are not able to do that, right? So that leaves us with this question, right? Are the markets efficient? And that's sort of debatable. There are people on both sides here. Some people who believe that markets are mostly efficient, and there is a group, again, like I said, predominantly behavioral group, that believes that markets are not efficient. All right, so looking at all of this evidence put together, in the end you will have to form your opinion regarding market efficiency, right? Whether you believe markets are efficient or not. You have seen evidence on both sides. Okay, and your view regarding market efficiency in turn is going to dictate what kind of investor you're going to become, right? So if you think markets are efficient, you would want to be a passive investor. If you think markets are not efficient, you would want to be an active investor. Now, a lot of students ask me, what is your view regarding market efficiency? So my view regarding market efficiency, actually there is a news article, there is an article that I've posted from Wall Street Journal on titanium that I'm going to go over now, and that is very consistent with my view regarding market efficiency. So let me pull up that article from titanium web page. So this article is called "Inefficient Markets Are Still Hard to Beat," right? So, so that is my viewpoint, that markets are not efficient. I think we have seen enough evidence. We have all these bubbles and things like that seem to suggest that markets are not efficient, right? And yet all these investors, mutual funds, and all, they're not able to beat the market, right? And that is what this article is talking about, right? As the title suggests, right? Inefficient markets are still hard to beat. So first of all, if you look at the data, right, some evidence, like from October 2007 to March 2009, the stock market fell by 94%, right? This was during the financial crisis. March 2009 was the bottom, and then from March 2009 up until the end of 2009, right, December 2009, the market went up by 380%, right? Huge swings in both directions in a very short period of time. How can you justify such kind of big swings in the market in an efficient market, right? I mean, it has to be the case that at some point during this period, the prices were not fair, right? They were not either undervalued or overvalued or both, right? So you can look at other episodes historically to see similar type of patterns, right? That markets sometimes go down quite a lot within a short period of time, like something like that, what is happening right now. But we don't know about the future in this case, how soon the markets would recover and go up. But we have seen historical episodes like this with big declines and big upswings in a short period of time. Seems to suggest that markets are not efficient, but at the same time it is very hard to take advantage of these inefficiencies, because let's, for example, you think that, or let's some investor, let's say, thought during the dot-com bubble period that the markets were way too high, all these technology stocks were overvalued, and shorted the market, right? Or shorted these technology stocks. Now that shorting does not necessarily guarantee that that investor would have made money. Why? Because the market, even if it is overvalued, does not mean that correction is going to happen right away. The markets can keep going higher for a period of time, right? So if you short and believing that the markets are overvalued, well, you might be right, but that does not mean that you are actually going to end up making money if the markets keep going higher before correcting, right? For example, a lot of right now, some investors might be thinking that this downturn has gone too far and maybe it's a good time to buy, but there's no guarantee that the markets would start recovering anytime soon. We can have further decline before the price goes up and before the market corrects. So it's very hard to time the market, right? So even if you believe that the markets are not efficient, trying to identify those peaks and troughs in the market and then taking your long or short positions accordingly, that is kind of very difficult to do, right? Market timing is extremely difficult, and that's the reason why beating inefficient markets still quite difficult, right? So that is basically why what I view or my view is regarding market efficiency. And I don't believe markets are efficient, but still it would be difficult to beat the market, and therefore most investors would be better off just being passive investors. All right, so that concludes our discussion on market efficiency. um, as you would have noticed, there aren't a whole lot of calculations here. There are actually no calculations in this topic. So it's all sort of descriptive in terms of reading assignment. I'm asking you to read this entire chapter. I pretty much covered everything. I haven't skipped a whole lot of material. So yeah, I mean that concludes our discussion on market efficiency. Let me know if you have any questions. Feel free to send email or join the Zoom uh, conference for office hours. Okay. So next up, we'll talk about behavioral finance.